Well, you're watching The Open, and we are watching the pre-market shares of New York Community Bank. Now, we would rarely talk about a regional banking player in the U.S., but this is a company that has raised broader market concerns, having to slash its dividend and stockpile reserves because of troubled loans tied to commercial real estate. This morning, the company said its deposits have climbed since the end of last year, and its liquidity remains, quote, ample. And the firm also appointed its chairman, a former bank CEO, to serve in an executive role alongside New York Community Bank's chief executive so that there are more hands on deck to deal with the uncertainty. But the shares are down. They actually had an initial gain this morning after the recent sell-off we've seen. That executive chair is taking questions from analysts on a conference call right now. And this story is also being tracked in Canadian banking circles. The country's chief regulator in this country was asked about Canada's exposure to these potential problems. Peter Routledge told reporters in Toronto yesterday that potential losses from commercial real estate is a manageable risk for our biggest banks. Bloomberg's Christine Dobby has been covering this story. She joins us now with more. Christine, good morning to you. What can you tell us about this view from Routledge, who oversees the Office of the Superintendent of Financial Institutions?
Good morning, John. Yeah, obviously this has been a big issue for Canadian banks as well as Peter Routledge. It's something that OSFI has been tracking. They put commercial real estate on their list of potential risks to the financial system last April. And as you mentioned, with what's going on at New York Community Bank in the U.S., there's been a heightened concern over this. And so we did have the chance to ask him about this yesterday. And he said that his intuition, he called it his spidey sense, is that Canadian banks will be okay on commercial real estate losses. He didn't say that there wouldn't be losses. He did say that he thought that they would be manageable, essentially. This is something that OSFI has been tracking for a while, and a couple of weeks ago, Peter Routledge told us that he expects banks around the world to suffer meaningful losses on commercial real estate, but that he expects this to be an earnings event for Canadian banks. You know, they're going to have to keep adding to their PCL provisions for potential loan losses, which can affect earnings, but he does not expect it to be something that really impacts the capital of the banks.
You've been sampling some of the various firms that measure risks through things like exposure, in this case, exposure, let's say, for Canadian banks to the American commercial real estate market. What have you uncovered on that front?
Right. So this does vary by bank. Most of the Canadian banks have operations in the U.S., but some of them are more and some of them are less exposed. For example, National Bank doesn't have any U.S. office loans. An office is really that pain point that everyone's really concerned about. Scotiabank has pretty limited exposure, whereas CIBC, RBC, BMO, and TD have more exposure to real estate risk. A few weeks ago, one of my Bloomberg colleagues reported that CIBC is looking to sell a block of $300 billion worth of loans in a number of American cities. So this is clearly an issue for some of the Canadian banks. But like I said earlier, this is likely, analysts think it's likely something that the banks will be adding to their provisions for potential loan losses, which, like I said, will affect earnings, but that they're likely to skate through this without too much pain.